Hi everyone, my name is Evan and welcome to our brand new series, Beyond the Charts. Beyond the Charts is designed to give you insights into the trade risks research process. We start by simply asking a question, and the question can be anything from, is there really such a thing as a Santa Claus rally, to something much more specific like buying a breakout after a very particular type of consolidation. No matter what the question is, we follow the same process each and every time that you might actually remember from middle school as the good old-fashioned scientific method. We start by simply observing the market, forming a hypothesis, and asking a question. Next, we gather our data, we write some code, and we conduct the experiment. Finally, we analyze those results and we compare them to what we thought might happen and draw some conclusions. So the goal of this series is 3 parts. The first is to simply ask questions and to test our assumptions about the market. Second is to learn how to write code. We're going to be looking at lots of code throughout the series and hopefully some new tools as well to answer those questions. Third is hopefully we get some good results or some meaningful conclusions from those experiments, and they'll actually impact the way we view the markets and invest or trade our own dollars. So all of this might not be for everyone. If looking at code makes your eyes glaze over, then we're going to leave some timestamps in the description of all these videos so you can jump around and jump to the end if you just want to see those conclusions, or in the middle if you're interested in learning how to program yourself. We're also going to have this available as a blog post so you can read through this instead of watching the video, and all of the code that we're going to go through in this series is going to be made public on our GitHub account for you to download and test out yourself. So hopefully this is interesting to you. We're super excited to get started with it. So without further, let's jump into today's experiment. Today we're here asking the question, does buying stocks hitting new 52-week highs lead to a profitable trading strategy? Now, it may sound counterintuitive to buy stocks that are at new highs, but this is referred to as momentum investing, and it's becoming increasingly accepted and popular as a trading strategy, and it comes in all different flavors. In today's experiment, we're going to be looking at stocks breaking out to new 52-week highs. So here's how it's going to work. Go back in time 12 months and follow a stock's trading history. As soon as we have a full year's worth of trading, we're going to make note of the highest price investors were willing to pay and prepare to buy the stock once it reaches new highs on the chart. After we own the stock, we're going to set a trailing stop loss and see how much profit we can capture. Lots of investors track the stocks hitting new 52-week highs on a daily basis. Most financial media sites are talking about it every day as well. Your trading software and screeners out there all have the ability to show you the number of stocks and the specific stocks that are breaking out to new highs on a daily basis. So, because it is so widely followed and tracked, we want to find out, is it worth paying attention to, and can it lead to trading profits? So with today's experiment, we're going to be building things out with NinjaTrader and Microsoft Excel. So without any further, let's dive right in. All right, here we go. We've got NinjaTrader 8 open. We have our strategy code started. Just like last time, we're going to be writing just a piece of this code, probably about 12 lines. It's a pretty straightforward strategy with some pretty simple rules, and I've already gone ahead and stubbed out kind of all of the other logging and declaration of variables and all that fun stuff. So you can follow along, you can sit back. All of this code will be available on our GitHub account, so you can download it, run it on your local workstation, and just have sort of the final output of everything that we write here today. So we've got our strategy here, which again, if you run through the strategy wizard, you get basically this template in NinjaTrader. I've added in some of the documentation, I've declared some variables, and if we scroll down, there's basically 2 methods that we are going to be writing together. It is the buy-sell rules, so line 111, and line 118, which is the closed at 52-week highs Boolean method as well. Those are pretty much all we're going to write here today. That'll get us our entry logic for this strategy, and then we will run the results. We'll visually sort of verify that they're what we expect, and then we'll crunch the numbers and look to see if this actually makes money. So let's kick things off here with our with the closed at 52-week highs, what I'm calling the helper method here. But basically this just returns a true or false value whether or not the close today is a new 52-week high close. That's all this thing does, and it will be called by our BuySellRules method, which we'll write after this. So 3 lines that we need to put in here. The first is to find the highest bar over the past 252 days. And the reason we use 252 days is because that's the approximate number of days that equates to 1 year in the market, because we don't care about weekends. So we want to strip out those weekends. We're basically left with 252 trading days in a year. That's a 1 year high that we're going to be going after. So finding the highest bar over the past 252 days, we are going to declare an integer, which is going to hold the index of, or the location of, the highest bar over the past 252 days. So essentially what we've got here is we've got a new integer declared, and we're using a built-in NinjaTrader function called highest bar. We're looking at closing prices, and we're looking at 252 days. That'll hold the index of the day that was the closing high price. So now we need the actual price, and the way we can do that is to declare another variable, and this one we'll just call the 52-week high. 52-week high should be good. It will be the closing price of the index that we just found. So this will actually give us the price value of the 1 year high. I'm going to move pretty quick here. There's lots of rabbit holes we could go down in terms of explanation and everything, but if you have questions, again, leave them in the comments of this video or on the blog post, and I'll gladly do my best to get back to you with an answer. So finally, now that we have that information, what we need to do is essentially return whether or not today is greater than our 52-week high. So the way we can do this is we can look at the bars array that we're running this on, and I'll explain what that is in just a moment. But basically, whatever, so bars array index 0 basically means whatever price series that we're running this strategy on, we want to get the close of the current bar. So give me the close of the current bar, and then let's compare it to see if it's greater than or equal to the 52-week high variable that contains the highest price. So hopefully that makes sense. Hopefully you're following along. You rewind and just listen to that sentence a couple of times. But that'll give us a true or false return, which will then help us determine if we have anything to do if there's a new buy signal. So that completes that method. That tells us where the new high is, what the new high price was, and whether or not today is greater than or equal to that price. So when we have that information, now we have enough to write our buy-sell rules. And our buy-sell rules are pretty straightforward. It's basically just going to be the result of this function that we just wrote, so the closed at 52-week highs result, but we also just need to make sure that we don't already have a position. So there's a few ways we can write this, but basically if we use this line here, this is essentially saying to make sure that we are flat on this position, that we don't have a current active trade in this particular stock. So as long as it closed at 52-week highs, and as long as we don't already have a position on it, then we want to buy. So we can do that by using the good old-fashioned enter long method, which we've used before in the past. And we are going to use this ComputeShareSize method. I'm not going to go through this again in this video. We sort of talked about it in last week's video. It's not really important here because we're not going to be caring about position size. We're not going to build a portfolio and equity curve like we did last time. We're really just looking for trade signals and the results of those trade statistics. So we could have entered 10 shares, 100 shares. It doesn't really matter for the context of this experiment. But what's important is that we are going to use a trailing stop in this experiment. So we're going to use a built-in method called setTrailStop, and the first parameter it takes is the name that we gave the entry signal, which is new 52-week high. We're going to set the calculation mode of our trailing stop to a %. And what that basically means is we're just going to use a percentage trailing stop for this strategy. There's a million ways you could write the strategy. There's profit targets you could introduce. There's lots of different ways you could compute trailing stops and fixed stops, but we're going to just keep things simple. And what we're going to do is use a simple percentage method, but we're going to use a variable so we can adjust the distance and run simulations on different distance stop losses to see if it impacts performance. So what we did is we're going to use this stop distance variable. I've already declared it and initialized it, and we can set it when we do our strategy test in just a moment. We can adjust the distance at which our stop loss trails. So that's it. With that complete here, we now have these two methods finished up. There's no profit target for this strategy, so it's just a trailing stop loss. And that's basically it. So what we can do is we can now kind of move this up here, and if I scroll down, you can see there's a bunch of other code that I was sort of holding back to not overwhelm everyone. It was the ComputeShareSize, the CalculatePerformance methods. We talked about those in our Beyond the Charts episode 1. They're not super necessary here, but I just included them in there for good measure. The OnExecutionUpdate, this is a method that we do need, but it's all just for logging purposes and keeping track of strategy performance. So it's not impacting BuySellRules. All of this is not for, really any other reason except for us to, really assess the strategy, which we'll do in a few minutes later on. So that's it. Everything is now complete, and we're ready to actually run this strategy on some historical data. So let's open up the strategy analyzer, and let's get this strategy ready to run on some historical market data. And the data set that we're going to choose to use is the Dow Jones Industrial Average, but the actual stocks that make up the Dow. So we're going to run it on the Dow sort of composite or constituents. And important note to distinguish here is that we're going to use a survivorship bias free Dow Jones Industrial Average index constituents, right? Huge mouthful, but basically what that means is we want to make sure that we keep track of all of the stocks that used to be in the Dow Jones 5, 10, 15, 20 years ago, right? So it is not okay to essentially run a back test on the current 30 stocks that are in the Dow and say that that was your hypothetical results, because what you're not accounting for are all the stocks that got delisted, got bought out, went to zero. I don't know if there's any stocks in the Dow that went to zero in the past decade or two, but the point is that there's a lot more than just 30 stocks you need to run this test on. So once again, this is why we recommend using Norgate as the data source, because they keep track of all of this stuff. So you don't have to, basically, and it makes sure that your data, your back test, is actually realistic and not sort of fantasy land in only picking the survivors, the stocks that remain in the year 2020. So survivorship bias free Dow Jones constituents. We're going to start our back test in the year 2000, so January 1st of 2000 to August 2020. And so we're going to also fill in our trailing stop loss distance. Right now I have 5% in there. You can put any number you want in there, but we're going to start off with just a 5% trailing stop. So stock hits new 52-week highs, buy the stock, and put a 5% trailing stop loss. So let's run this test. And let's see what things look like after we run this test. So we've got some results here, and our first step is let's just visually kind of compare and verify that the strategy is actually buying and selling when it should be. So I clicked on so ticker symbol BA. So let's just go back here in time and sort of visually inspect at what's going on. So here we are. You can see back in 2019, $389 looks like a new closing high. Our strategy buys. And then you can see the trailing stop gets triggered a couple of weeks later around 413 because note here, so let me switch over to this view, we got as high as about 436, and then as the stock continued to pull back here, it hit our 5% threshold, and you can see we exited right there. So that seems like it is working as intended. Let's go back a little bit further. So here we are now back in 2018. The stock closes at new highs. So you can see it takes out the old peak, and then we get long, stock rallies, get trailed out, and exit the stock a few days later. That looks correct. Back up a little bit further, stock breaks out to new highs, continues just a little bit, gets stopped out. A lot of whipsaw here in early January, essentially buying the stock, getting trailed out, buying the stock, getting trailed out. So this looks like things are working as intended, and I've already sort of behind the scenes double checked on this code, so this should be in pretty good working order. So our next step is to actually kind of put all this together and see if it collectively has made money over the past, in this case, 20-year backtest. So what we're going to do is we're going to export all of this information to Excel, and then we're going to crunch the numbers and look at some graphs and metrics using Microsoft Excel. So we'll be back in just a second. Okay, we're back here. We've got Microsoft Excel open, and all I've done is export all of the trade data from NinjaTrader into Microsoft Excel, into this template that I built out to just more closely analyze some of the statistics behind the strategy. NinjaTrader is capable of doing some of it. I tend to like to compute some different stats and just get the trade data imported myself so I can look at things a little bit differently. But we have all of the trade data here. 5% trailing stop loss on the Dow Jones Survivorship Bias Free Index. Let's take a look at metrics first. So here are the sort of end results, the stats, if you will, of this trading strategy. So there were a total of 1,927 trades, almost 2,000 trades across 19 years of a backtest. So remember, it was a 20-year backtest. We started in the year 2000, but our strategy requires one full year of data. So you need a 52-week high. So you got to wait for that full year to go by, which means your first trade doesn't actually happen until 2001. So it's a 19-year backtest, which basically gives us about 96 trades per year. That's the average. Now, some years are going to be more active than others, but that's the average. Average hold time on number 7 here, row 7, is 31 days. That's a calendar day, so basically 1 month. That is the average amount of time that you are spent in a trade once you buy that 52-week high. And the cumulative R after all is said and done is 168.71. So whatever your risk is on a trade, if it's 1%, then this would have been 168% return over 20 years. So remember, it's only the Dow Jones universe, and that's if you risk 1% per trade, and you could take all the trades. We're not factoring in position size or comparing it to buy and hold at this point. That's a good next step, but that's not so much what we're looking at here. We're really interested in kind of this next grid, which is the percentage of winning trades, and then how the winners compare to the losers. So in this particular strategy, you can see that the percentage of winning trades was only 38.4%. So most of the time when you bought this, when you took the signal and bought the new high, most of the time that resulted in a losing trade. However, you can see on the next row, the average return of winners is about 6%, and the average return of losers is negative 3%. So what that gives you is a positive win-to-loss ratio of just about 2, just under 2, 1.98. So that basically means, you're only winning at 38% of the time, but when you win, your winners are almost twice as big as your losers. And so if we were to look at the actual chart of this, you actually can see that this does produce returns over time. This is not exactly an equity curve, because an equity curve would require us to think about position sizing and portfolio composition and mark to market all of these days. What this is basically just looking at the results as soon as the trade closes out. So I'm actually graphing the R multiple, a cumulative R multiple over time, and the graph is being updated as soon as the trade essentially closes out. So it mimics an equity curve, but it's certainly a little bit smoother than a real equity curve would be. And again, it just doesn't factor in position size. But it gives you a pretty good indication here that if you were to run this strategy over this 20-year period on the Dow Jones, it in fact made some money. Buying 52-week highs with a 5% stop did in fact work. So if we kind of trail off here on the last couple of metrics here, you can also see this does have sort of trend following characteristics, or at least the characteristics that your winners, so your three largest winners over this time period, 54%, 38%, 35%, versus your three largest losers, 13, 12, and 12. Were much bigger. So your average winners, your largest winners, much bigger than your largest losers. So pretty promising results. So let's actually change things up. Let's look at a 10% trailing stop loss, because remember we made the stop loss variable so we could control just how wide that stop loss was. And so if we pull in another spreadsheet here and we look at a 10% trailing stop loss, what you'll notice immediately is that the number of trades decreases pretty dramatically. So it basically gets cut in half, a little bit more than half, down to 905 stocks over this, 905 trades over this 19-year backtest. So a lot less trades. The average hold time jumps to 114 days. So basically, we were at a 30-day hold time the first time. Now we're at 114 days. And one of the most important stats is your cumulative R is now 212. So your total net profitability actually went up by raising the stop loss. So even though you took less trades, you actually made more money in this particular backtest. The percentage of winning trades jumped up to 42%. The average winner's bigger, the average loser's bigger, and then your average win-to-loss ratio actually went up at the same time. So you won more percentage of the times, and you also increased the ratio of winners to losers. All in all, a very good thing by increasing that stop loss distance. If we take a look at the chart here, pretty similar. I mean, the path is pretty similar, a little bit of a smoother ride, and it does end up sort of getting to the same place for the most part. But again, just a more healthy sort of a depiction here of trading stats. So last but not least, let's take it one step further. Let's increase the stop loss one more time and go to a 15% stop loss. So if we look here at a 15% stop loss, once again, we can see that we nearly cut the number of trades in half again. So now we're only taking, let me zoom in a little bit, 502 trades over this 20-year period or 19-year period. So that brings us down to 25 trades per year. Remember, we started with nearly 100 trades per year. And then take a look at the average hold time in this particular 15% trailing stop loss strategy. 285 days now is the average hold time. So you're sitting in stocks for nearly a year. And the most important statistic is probably row 8 here. The cumulative R continues to go up and into the right direction now, 280, spot 46 over this 19-year backtest. The percentage of winning trades here also now nearly a coin flip, so 47.41%. Remember, our first strategy with a 5% trailing stop had basically like a 38%, 37% win rate. This is nearly, 47.41. The average winning size went up. Average losing size did go up. But look at this ratio now is 3.16. So once again, we saw more stocks winning. The percentage of winning stocks went up, and the average win to loss ratio also went up. So both of those speak to increased profitability. The equity curve, see basically this thing looks more smoother, and again, it's not a pure equity curve, but the performance profile here continues to head in the right direction. It's smoothed out even more, and it covers more ground to the upside. And if we look back here at the performance metrics, take a look at the largest winners now in this particular strategy. You're getting 204% largest winner here, 149%, 137% for your largest 3 winners. And your largest 3 losers, of course, did go up, but certainly much smaller by a factor of 10 compared to those winners. So this is good news. Less trading, more profit. That certainly checks the box of personally what I'd be interested in, is seeing more profit and being able to do less, stare at screens less, so on and so forth, less commissions, less slippage, less taxes. All that stuff is something we sort of like to see. So we're going to end it on that. We're not going to go any further. We could go on and test 20% stop losses, 25% stop losses, but I think we covered a lot of ground here today. And, really, we set out to ask the question of buying 52-week highs as to whether or not that can lead to profitable trading strategies. And I think we demonstrated that the answer is yes. It certainly does lead to profitable trading strategies. Of course, we sort of just scratched perhaps the tip of a real rigorous test. We, of course, would want to test more markets or more individual stocks. So we want to get outside the Dow. Let's see how small caps perform. Let's see how S&P 500 stocks perform. Let's try and get some different price history decades in. So if we get back to the 90s, the 80s, the 70s, that would be really cool to test even further back to see if the strategy still holds up in different market environments. So those are all sort of the next things that we would sort of want to test if you're really going down this route to build a 52-week high sort of breakout system. But we at least got the ball rolling, and we've got 2 other things that I think are actually very interesting that we sort of uncovered in this particular experiment. The first was stop losses. So like we demonstrated here, going from 5% and from 15 to from 10% extended and increased profit in each of those cases. So I think we have, some of the ingredients, some of the data supporting the fact that wider stop losses is a good thing, at least for this type of what I would consider trend following momentum type of strategy. I'm not sure if this is going to hold up in all cases, but certainly we saw that there was some good evidence here supporting it. The other thing I wanted to point out, which I didn't actually mention at all, is when we look here at this equity curve or this performance profile, what I want to actually just bring our attention to for the last couple of minutes here is the stretch of the strategy not producing returns, right? So take a look here from 2001 to 2004. This strategy basically went nothing but down to sideways. Same thing from 2008 to 2012. Now, obviously, those were bear markets, so nothing in terms of equities were really doing well during those periods. But this is this is something where you need lots of conviction and lots of fortitude to really kind of stick with a strategy throughout a multi-year I don't want to call it underperformance because we actually don't know if it underperformed. It probably, I would imagine that this type of strategy would outperform on a risk-adjusted basis, but it's still a multi-year period where there were no returns generated. And so for most traders out there, they are not going to stick with a strategy that doesn't produce results for, usually multiple months at a time. Traders are already kind of moving on to the next thing, let alone years at a time. So I think this goes to show you that you can have a very profitable, in this case, breakout system that seems to work well over a multi-decade period, but in the interim of multiple months or multiple years in this case, it can actually go sideways, underperform, or just not do a whole lot. And it doesn't mean that it's broken or doesn't work. It just means it's not in favor right now, and that maybe better times are sort of down the road. And I think that's an important lesson that really translates to, I think, all of us, no matter what we're doing. The analogy here is 52-week high breakouts, but you could be doing some short-term mean reversion thing, or you could be doing some pairs trading, and perhaps it's not working right now, but it may not just be the environment, the conditions that you need for that strategy to really excel in a bigger picture context. So hopefully this was interesting. We got a couple of bonus little tidbit takeaways here. And as always, I'd love to hear your feedback, and I'd love to know for future episodes, what are you interested in? Are there any other strategy systems, or even just behaviors in the market that you want to see tested? And hope to see you back here in a future episode. Thanks so much. Hey, it's Evan here again, and I'd love to know what you learned from this episode. Was there anything that stood out or surprised you? Leave a comment below and let me know your thoughts. Thanks again for tuning in and watching.